Hi and welcome to this episode of Scientific Investors series from OMNI Capital. Today we are discussing about a very common valuation ratio, which is price to book value. And we'll try to give you an insight into how what is all about price to book as a valuation ratios, where the applicability is there for this ratio, and how you should go about safeguarding yourself once you are using this. So Vikas, I think let's just start from the very basic and
Sure.
what is the price to book ratio.
So price to book is basically the market cap of the company to the net worth of the company. Right. So net worth of the company includes the issued share capital and all the reserves and surplus.
Right.
That is the shareholder funds or net worth. So you can do it this way, or you could say the share price divided the book value per share.
For sure. Right.
Great. That's the definition.
So, it's a popular one, and for decades, I think people have been mentioning price to book as a good valuation ratio. So, which are the sectors or which are the type of companies it has a best applicability when it comes to?
Yeah, so the banks, I mean, it's most popular when people evaluate banks, right? And even any other lender.
Right. NBFCs.
Right? Yeah, NBFCs, housing finance companies. Okay. That is where you can look at price to book. And the typical understanding is that price to book of 1 is a fair value for a bank. Right? This is the traditional understanding worldwide, or probably coming from US. Now, I'll just digress that for India it doesn't make sense, because this would be true if there were any number of bank licenses being given and it was an open market. Then price to book of 1, because there is no advantage of one bank over another bank. Money is money, it's all fungible. Anyone who's willing to give it to me cheaper, I'll borrow from them. In which case it would be a commodity thing and price to book of 1 would be justified. Now, given that in India there is licensing is a little bit controlled or significantly controlled, you can't just walk anywhere and get it. A lot of banks seem to be around, but still the supply demand, there is a mismatch, and so a price to book of 1 is not necessarily usually available.
Right.
Okay.
Right. So and again that because of like no one can set up a bank just like that easily. There is some premium that is given to to investments, like
Exactly.
the intangibles that you have created over a period of time. So some weightage should be given to that as well, not just what is there on the books.
Exactly. So banks are actually able to make slightly more profits
Right.
than the cost of capital. Since they are able to, or cost of equity, since they are able to make more profits, more than the cost of capital, that is why there is a premium, and still it would be a fair value even at some premium to price to book. But yeah, this is the sector where it's most applicable. Okay.
And definitely to some of the asset heavy businesses, because where the book actually carries a weight in terms of the operating business of that particular
Yeah, in
company.
fact, you take all your asset heavy cyclical businesses, right? They're cyclical because they're asset heavy.
Right.
And when, let's say, they are in the downturn, economic downturn, and they are showing negative earnings, so you can't use PE anyway.
Right.
Now it makes more sense to look at price to book. Or even when they are at peak, then they might show very low PE,
right, and very
because
high
the E is very high at the cyclical peak. People might think it's cheap, but the better way would be to look at price to book.
Okay. Yeah, true. So in terms of the typical traps, as you call, what are the things that one should look at, other fundamental ratios, when you are kind of considering price to book as a valuation ratio?
Right. So many value investors, right, even Nobel Prize winners, you use the inverse of price to book to market kind of thing, right? So price to book is very popular that sense, especially with value investors. And value investors trust assets more than earnings. So they go even better than PE, they think PB. But the problem is, obviously you have to be careful about value traps.
Right.
So what can go wrong? Lot of low PB stocks are naturally high debt stocks. Okay.
Yes.
So that's the first thing. Second group of low PB stocks would be companies with negative earnings,
Right.
loss making companies. Third would be negative cash flow companies.
Right.
So these typically negative cash flow companies have a corporate governance issue also attached with them.
Right.
So they might be showing very high PE, very high earnings, profits, everything, but the market doesn't trust them.
Right.
So the PB is low.
Right.
Okay. And there is huge cash on the books, but people feel it's not really there.
Right.
There is huge receivables. There is a lot of profit, but it's not translated in terms of cash flows. So these are some of the things you have to be worried about when you see low price to book.
Sure.
Okay. Otherwise, you fall into a value trap. Now, if you avoid all of that and still you have low price to book, then maybe there is something to investigate further.
Correct. So when you go to the next step, and obviously you're taking care of these typical mistakes, that just looking at the ratio to find a value investment opportunity, what the other kind of normalizations that one investor should look at?
Right. So now two problems, right? The book value can be overstated or it can be understated.
Right.
The overstatement typically comes when we are in like a market bubble or market has been in a bull run for a long time and all the easy picks have gone by.
Right.
Now people start looking at, they find something is cheap on price to book, which is typically it turns out to be a holding company.
Right.
Right. And it looks cheap. First of all, there is a justified discount to a holding company value, right? That is okay, 20% or something. But despite that, it looks like it's cheap. And the reason could be that what the holding company is holding, those companies might be overvalued.
Correct.
So if they are overvalued,
and because of that, the book value is looking high, then that's not
and you think you're buying that at cheap. It's something you have to be careful about. So the adjustment has to be lower.
Right.
So the holding companies, the companies which are being held by the holding companies, you have to give their normal values, conservative values, and then see if you are getting a discount. That is overestimated, overstated book value. The other one is the understated book value.
Right.
Because typically, let's say a company has a lot of land and it was incorporated in 1975 and they bought land at that point of time. Now it's all carried on the books at the original price. Right. And nobody goes and updates that price.
Correct.
So it's significantly understated.
Right. Correct.
So if you adjust for that, that is the normalization you need to do to get the true value of the assets.
And sometimes there are like more liquid assets on the books. In that case, how do you use price to book as a
so liquid assets is the easiest, right? If everything is liquid, then most likely it's at fair value.
Right.
And there is an obligation for the management to state the
usage, planned usage or for that assets, right?
Yeah, usage is fine, but even if they're not going to use it,
so
the value is at least whatever it is, right?
True.
Typically.
True.
So then you don't need to worry too much.
Right.
Unless it's a loan given to a specific group company.
Correct.
Or one single company.
Right.
Even if it's outside the group. Then you have to be worried that is that going to come back?
Yeah? True.
Yeah.
Great. So this was in the series that we are currently focusing important fundamental concepts of investing for our scientific investors, and stay tuned, we'll come back with more interesting ideas on this. Thank you so much. So always keep in mind that investment in securities market are subject to market risks. Read all the related documents carefully before investing. And also that registration granted by SEBI, membership of BSL, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors.